Thank you very much.
Yeah.
The stage is yours.
Thank you.
Thanks.
Okay, so thanks a lot for having me, Friedrich, Marius. Cool spot here. Kind of wish I had brought my sunglasses, but that might be overdoing it. So I thought I would wear this funny thing in my jacket here so you knew I was from Munich or something like that. And but maybe just 2 minutes of my own sort of where I came from and what I'm doing here. So in case you haven't noticed, I'm American. But I'm in Germany around 33 years. So wenn ihr wollt, ihr könnt auch Deutsch sprechen. Man kann sogar das Ganze auf Bayerisch machen, da kann ich auch machen. But we're going to stick with English tonight. But so I came in 1983, right out of college. The IBM PC was just launching. I didn't have, my college roommate and I came up with this idea that we wanted to be just like Bill Gates. And so, but we didn't have any software, so we decided to take software from American companies. We would then translate it into German, which was a language we didn't speak at all. And we would become millionaires in about a year. We figured 2 years maximum. And yeah, I mean, we didn't have any money, we didn't have any software, we didn't speak any German, so it was perfect. And we came to Germany and had a 12-year disaster, followed by, so we lost about $850,000 of family, friends, and fools' money. Finally figured it out and turned it around. Fired half the company on one day, helped most of them get jobs, by the way, and turned the company around. I spent another 2.5 years paying back all the investors, 2 to 1, and I was debt-free and back to zero 14 years down the road. So it was 14 years to zero. So, and my second company was, my first partner and I are still buddies, but we just go skiing together. And I started again myself in '97, bringing US consumer software this time over. I could speak German, I knew what I was doing a little bit. The internet was taking off. That company did pretty well. We were publishing US software. So we opened in Germany in '97, took over actually found a partner in England in '98. She and I took over a little French company in '99, and we sold to a French public company in 2007 and never had raised any money because we couldn't get any financing, because we didn't own anything. We were just licensing software and nobody wanted to invest. So I often say, just for all of you today, that venture capital is the best thing that never happened to me. Yeah. So when I exited my first company 20 years down the road, I own 60% of it, and there's a lot to be said for that. So for entrepreneurs as well. But the process after that was actually joining a big company. And I was there as chief operating officer for about 5 years. We grew from around 35 million when we joined to a little over 100. I got into the corporate world a little bit, and then decided after 5 years I'd had enough and started the Entrepreneurship Center at the LMU. So we've had around 215 companies come out there. Some of the ones you would know would be like Flixbus started there, and Unu started there, and well, a bunch of others that you guys might all know. And those companies have around a market cap today north of, let's say, 850 million. And we picked them basically just by looking at the entrepreneurs and saying, do these people know how to build businesses? Will they make it? Yeah. And then the German accelerator is with the German government. So just sorry to make a little pitch, but if any of you are interested in going to the States, the German accelerator is a really cool program. You get sent to Silicon Valley, Boston, or New York, and you have to pay your airfare and your room and board, but you get connections to capital. And we've helped companies now raise about $250 million of US venture into those companies. So really interesting. 2 winners standing right here. What's your company called? Dialogue 360, right? 360 Dialogue. So, and then just a word about Deloitte Digital. You know, why does an entrepreneur go to a company like Deloitte? You know, there's a lot of hype about corporates and startups working together, and for the most part, it really is a lot of hype. I mean, it doesn't actually work that well, and I wanted to find out why. And I thought that the best way to do that was really to dive in. So we decided to become a company builder. So we're actually Deloitte Digital Ventures inside of the bigger Deloitte Digital. And we're basically doing build, operate, transfer of companies for large corporates. And it's a growing market. It's really interesting. But they really need a lot of hand-holding. So, and then I decided that I needed to start doing some serious investing and raised a small angel fund about a year ago. So that's kind of who I am in a nutshell. And I jump into what I'm going to talk about today is, what do investors want to see? What are they looking for? And why do they invest? Yeah? And who do they invest in? And so I apologize, but I need to look at some notes here. Give me a second. But the first thing, one of the things that investors like is they like to invest in companies where the founders know what they're doing. Yeah, it's like a really important thing, like having no idea what's going on and not knowing the process and not understanding how financing works is really not a good thing, yeah? So, just a couple of things before I jump into the investor's perspective. What's your perspective? And so some of the things, a lot of people say, well, when should I start looking for money? And the first thing that you need to make sure before you start looking for money is, do all the founders agree that you want to raise money? Okay, so you need a united founder team. The founders have to be absolutely rock solid that they want to do this. That means you got to have your valuation agreed upon. You don't want to walk into the investor meeting, they say how much you're worth, and somebody says 5 million, the other says 2, right? And that kind of stuff actually happens. So you really need to make sure all your team is aligned and you say, this is what we want to do, I'm ready for it, and let's go. And from the moment that all the founders really decide that they want to raise money, you're somewhere, I would just say, conservatively speaking, figure you're 9 months away from money in the bank, okay? Really money in the bank. That means the whole deal closed, it's been transferred, it's yours, and you're ready to go to work, okay? So it's a little bit of time, and you need to really understand a couple of things. I mean, you don't want to go into a financing round unless you understand your 3-year financing, okay? And so what that means is you actually need to put together a financing plan. What I see really way too much is, hey, we're just going to wing it, we're going to check it out, we'll see how it goes, we're going to get started, and nobody's actually sat down and done the numbers. It doesn't mean that the numbers won't be right, okay? The numbers will be wrong. Yeah, but somebody has sat down and really gone through it in detail and understands what the business plan is really about. And I think if there's like one thing that really disqualifies you in front of an investor is when they take the spreadsheet and they start asking you questions and you don't know where the numbers came from. And so just a couple, a couple of things here. If you want to think about like how long will it take, I would say that putting together a good financial plan is somewhere around 2 months of work, okay? 2 months of solid work. Yeah, and that's just to give you a real number. If you do the math, that's 300 hours, okay? So I don't mean like, somebody just kind of sitting around, you work on it a day and then you don't work on it for a week and then 2 months go by and you have your finance plan. I actually mean somebody sat down and spent 300 hours on the plan and knows everything about it. Then you become impressive and you really know what you're talking about when you get into the negotiation. The other thing is, you want to be ready for due diligence, okay? So on the day that you walk in, and it's great to look really relaxed and you just happen to have everything together, but that takes planning. You don't just happen to have due diligence together. What it means is, my note is about a month of work. That means all your contracts today, it's scanned, so you have it in some kind of a data room, and you have all the information ready, and you have all the contracts, and you have all the employment agreements, and you have all the insurance, and you have all the legal issues, and you know your company. You know your company. That's the most important thing. And that takes about a month, and there you're talking about, 160 hours that somebody ought to be spending on getting it together. And so one of the challenges that a lot of companies have is they don't really have the team together to do the work. They've got, maybe they've got the technical people and maybe they've got the salespeople, but they don't have the finance person or the controller who really understands what the business is about. And it does take real time to get this kind of stuff done. How much time does it take? Well, I would say that it's something like 3 months from term sheet to cash, okay? So from the day you get a term sheet from someone and they're really serious, and by the way, if they can't give you a term sheet, they're probably not that serious, yeah? But from there to cash is about 3 months or something, and maybe if you're doing an angel deal, maybe it's 1 month. So, our process is like 10 days. We can tell you if you give us the things we're looking for in 10 days whether we're coming in, but that's really fast. a month would be also really fast. And a VC deal, I don't know, 2-3 months or something like that. It usually doesn't go that fast. So, and when you're approaching the investors, right? Like, so how do investors generally like to be approached? I mean, there's not like a rule about it, but let me say it this way. If Friedrich or Marius tells me this is a really good company, the chances of me looking at it are like way, way higher. Yeah, really big difference as to whether or not I just get approached on the street. Now, having said that, I was talking to one of my investments this morning, a company called Flare in the mobility space, and this guy literally ran up to me after a lecture at the university, and I decided on the street to invest in the company. Now, not a lot of money, be it, yeah? So, 25K, but that's really more the Ausnahme, more the exception than it is the rule. So try and understand, either other startups who know those investors or something like that, but try to find a way in where you're recommended. That usually makes a big difference. And when you sort of say what are they looking for, I think that investors are looking for a couple things, and one of them is definitely vision, right? Like, where are you going? And if the difference between vision and mission is really important. Vision is, I see something you don't see. You see, and I'm investing in your company because you see something I don't see. Yeah, and so if you can't tell me what it is you see, then I'm not ready to go on the mission with you. I'm not like going to go down the long road. If you can't show me what it is that you see and I don't get it, I don't get your vision, chances are that I'm not coming along for the ride. And the next thing is you have to keep in mind that, especially when you get into the VC arena, okay, if you talk to the venture capitalists, I think we have probably some here today, but how many investments are they making out of 100? Well, it's somewhere between 1 and less than 1, right? So you're 1 out of 99. You got to be better than the other 99, and you have to think about the fact that every single company that's approaching them, and by the way, I really mean sometimes it's a lot less. If you look at a company like, let's say, out of Munich, Target Partners, I think they look at like 2,000 plus deals a year, and maybe they do 6 or 7. So you can do the numbers on that, right? And you really want to be able to, the investor is, every single company that's approaching an investor has the best business plan ever, right? Everybody's got the best business plan, yeah? Everyone's got the best idea. So it really comes down to, and I know this is sort of like sounds like old hat at this point, but it really matters is, do I believe that the people who are presenting this plan to me can actually deliver on what they say? Yeah, and there's just not that many people who can really deliver on what it is that they promise. So when people say, there's this joke about in real estate, the 3 most important things are location, 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 right? Well, in venture and in investing, the 3 most important things are management, management, management. Like, do I believe these people are going to be forthright, tell me when they have problems, be able to pivot, deal with all the crap that's coming at them, handle all these things at the same time and become successful? That's why I'm looking for the team. And when you end up with a team where you have a bunch of, of guys who understand sales and marketing, and then they're going to outsource all their tech work, you kind of say, boy, I hope there's somebody who really understands that they've picked the right tech people, And if then there's somebody who says, well, we're going to raise this, we're going to raise €1 million in the next round, and that'll be in about 9 months, then I really want to see who on the team is going to spend the next 9 months, day and night, doing all the investments, doing all the meetings, right? So if you want to look at a really, really cool company, a really cool accelerator, have a look at something called H Farm. H like human and farm like the farm. It's down in Venice, and they're running great programs. And we were down there recently talking to them, and they said that they did an analysis of all their portfolio companies, and all the companies that have come through in the last 10 years. And they analyzed that the average startup is talking to around 72 investors before they actually get the deal. So if you're going to talk to 72 investors, you need to have somebody on the team who really understands how to do it and who really understands the details of it. And if I had to say what's like the one mistake that you make, I just say it again, it's not understanding your financial plan. It's being not able to back up why you think what you think. Yeah, and that means, when you're making, it's pretty loud. Let's put it this way. You have to make assumptions, right? You have to, there's a great quote by John Kennedy, actually quoted an Irish poet named Frank O'Connor when he was talking about going to the moon. Yeah, and what the I think it really sums up what entrepreneurship is. What he said was, the poet writes, when I was younger and I would be walking across the orchards and we would come to an orchard wall that was too high or too difficult to get over, I simply took my hat and threw it over the wall, and I had no choice but to follow. You see, and that's what entrepreneurship is. It's just throwing your hat over the wall and saying, I'm doing this, we're going to make this work, and I don't know how, but it doesn't mean you haven't thought about how. Yeah, and thinking about how is like, what are the assumptions, what are the assumptions backed up by, and be able to really go into detail and tell people what is it that's behind that. Because then they realize that you're serious. Okay, now I take a break while the guy's going by. It's the problem with mobile phones. They go off. So, basically, what would be best practice for being ready? Okay, I would say you should have a one-pager ready all the time. And you should update your one-pager at the end of the week, right? So that when that moment comes and you happen to see the guy on stage and you run up after him and he says, yeah, send me something, that like before you get out in your phone, he doesn't even get to his car, the one-pager's in there, right? That's like really, really ready, yeah? They're looking for a certain mentality. I had a very long discussion this morning with a group of angels from 8 to 8:30 that went till 9 o'clock. And we were talking about a company whose name I won't mention, okay? And it was really interesting because we're looking at what do we do? Like they didn't get to where they said they were going to get to. They didn't get the round that they thought they were going to get. And now they come back to the angels and say, can you help us? And what all three of the other angels said is, you know what these guys are? Und das ist ein super Wort auf Deutsch. Ja? Es gibt's einfach nicht in Englisch, deswegen sage ich das auf Deutsch. Aber was Investoren wirklich hassen, ist, wenn du beratungsresistent bist. Ja? Beratungsresistent is wirklich hard, yeah? So, you could call it coachable, right? And by the way, coachable doesn't mean that you sit there and you just do everything that your advisors say. That's not what coachable is. Coachable is, I'm really listening, I'm really thinking about how to do what you're saying, this is why it won't work, this is what I see, let's find a way together, but I'm listening. Yeah, and there's just so many startups out there that just don't listen. So, I like people who really believe in what they want to do, and they're really, really committed to it. But, when you really talk to the companies who have made it, you find that a lot of them have pivoted. So you need to be coachable. The other thing is you need to be ready to report, right? We're giving you the money. You've got our money. What do we get? We get a monthly report. What happens when the monthly report doesn't come? It tells me that nobody's organized, right? It's like, oh man, the monthly report's late. Yeah, okay. Once or twice the monthly report can be late. But when it's always late and then it turns into a quarterly report, then I'm like, this is not going well at all, right? Because why? Because you need to know what's going on in your company, right? It's like, and if you're not reporting among yourselves, you don't know what you're doing, this is not a good sign. And I know a lot of the things that I'm saying today are really common sense. My dad had a great saying. He said, common sense is not often common. Okay? So, you have to be, reporting is not a chore. It's something you owe to yourself to do. And the other thing that investors are looking for is they're looking for speed and they're looking for completeness of information, right? So it's like, if you send me something, what I don't want is, here I'll send you this today, and then I'll send you this tomorrow, and then I'll send you this the day after. It's like, I really have a lot to do. I do a couple other things besides watching out for your company. Couldn't you just send me everything at once, like when you said you were going to do it? And, and that really comes down to what I would call dependability, right? Like, are you dependable? And by the way, if you're not dependable, then really don't bullshit yourself and say that you are. Like, be honest with yourself. Be honest with yourself and your partners. Like, if you have a partner who's always fucking up all the time and never does what he or she says, then either accept that that's what they are because they're a total genius and they're doing it, they're writing the greatest code that's ever existed in the history of the world, or sit down and have a conversation about whether the partnership is going to work, right? Because if you get into an investment and you can't be dependable for each other, then you're going to have a really hard time being dependable for the next group of people that are putting in money, And people, when they put in money into your company, they really don't like to lose their money. Yeah? I mean, they know that it's going to happen in a lot of cases, but they don't really like it. Yeah. So, and now if I sort of had to say, like, a lot of people say, does frech gewinnt? Yeah. I mean, and there's just a lot of people really. Yeah, frech and bisschen. And what I don't know. I don't think arrogance is great. I don't think it's like a really good sales pitch, arrogance. I think that highly confident and respectful is really strong. Like, I really do know what I'm doing. These are the people that are behind me, and we are going to be successful. The boat is leaving. Do you want to get on the boat? If you don't, we'll call you the next time it comes around, but let me know. Yeah, but very respectful and respectful with each other. Like, I can count on this guy. He's doing the finances. He or she is doing the marketing. He or she is doing and here's my team, right? And you can count on us. So now that's sort of how you ought to be, I think, because that makes it easy for you. It's more enjoyable to do business that way with your partners, but from the investor mentality, the first thing that I would say is, you have to understand that the basic investor mentality is, I don't need to do this deal, right? I really don't need to do this deal. And it's not because I'm arrogant. Yeah, it's just true. Like, I don't need to do this deal. There's like so many deals out there, right? So you have to understand that they don't need the deal. It's not like, now, sometimes you have the deal that everybody wants to get into, and that's great, but I would still be respectful in that case because you don't know what happens the next time you need the round, and if you don't let them into that round, they'll remember why you didn't, right? And it may be that next time around you need them. So, that's the first thing. Yeah? The second thing is that, and now I'm talking very specifically a little bit more about angel investing than I am about VC investing. Why? Because I'm not a VC. Like, I've never gone out and raised a 100 million or 200 million euro fund, and I've never managed funds of that size. I've invested with my company. We've done 30, 40 million euro deals that we bought with AvenQuest software. So I was running the M&A department there for a number of years, so I know about it, but I'm much more at home in an angel investment mode. So I would say that don't underestimate the gut feeling, right? It's like when you walk in the room, you got to grab them. Like, they want to be, I want to be really impressed. I mean, you can, I guess, I don't know if Samver bashing is still a pastime in Berlin or it's over, but I don't know if any of you have ever heard of a guy named Rolf Dienst. Rolf is the founder of Wellington Partners, one of the first venture capital companies in Germany. He's kind of the Papst of venture capital in Germany. And he talks about the first time that Ali Samver walked into his office to pitch him, I guess it was their ringtone company. Yeah, and he said, after that guy left, it wouldn't have mattered what he was selling. I would have invested no matter what. Yeah, and so what that is it's passion, right? And passion is not just like about jumping up and down on stage and I'm really passionate, I'm really passionate. Passion is the details of what you're doing. You're an expert in what it is that you do. You are better than your competitor because you know more than your competitor. You are faster than your competitor. I remember really, really well when the guys from Flixbus walked into my office at the Entrepreneurship Center, and I had, I'm looking at them, and there's these two BCG consultants, telling me that they're going to absolutely revolutionize the bus industry. And I'm looking at them, and I'm saying, I don't know why, but I actually believe these guys are going to do it. And part of the reason that they convinced me was they had a vision. They showed me a picture of a bus today with a bunch of people that are like 60 to 90 years old getting on the bus, and then they showed me a picture of what the bus should look like. And if you know who's getting on a Flixbus, they did it. Like they turned something that wasn't for young people into something that's cool with great Wi-Fi and all these things. They had a vision, but they were also really passionate about it. Like they were able to tell me all the laws about why they thought that the laws were going to change, and then there was going to be allowed bus routes, and in the end I looked at them and I said, so guys, basically what you're telling me is you're in PowerPoint mode, right? And they said, yeah, we're in PowerPoint mode. So they were honest. Yes, they were in PowerPoint mode, but you could tell that these guys had really, really done their homework, and that's just incredibly important. So, and the other thing, especially about angel investing, I know it sounds really odd, but angels also want to enjoy themselves, right? Like there's definitely a kind of like a no asshole clause, that you want to invest with people who, when the shit is going to hit the fan if you're an angel investor, right? I mean, it's not like maybe it's going to hit the fan. It's just, when is it going to hit the fan, right? It's obvious. Nobody's going to get through this thing. I almost died 100 times right along the way. It's not fun, right? So you want people who, when that happens, don't like hide behind their little finger and they can't get them on the phone. No, you want people who walk and say, look, we've got a really big problem. How do we handle it? This is what we think. Here's 6 solutions. Do you have any others? Okay, let's go do it. So that's fun. Every breakdown is the opportunity for the breakthrough, and you have to be ready for that. So, and then when you really say, what are they looking for? What are the investors looking for? I tell you sort of a couple classic things, and then we just do quickly how to close a deal, and then I'm off stage and you can enjoy the beer, okay? So, in the end, it is still a couple of the basic things, right? It is market size, right? It is market size. I mean, if you're going to tell me that you're going to grab 10% of a 400 million euro market in the first year, I just don't believe you, right? So, and if the market is 40 million, then I don't want to hear that you're going to be a 10 million euro company in 2 years, because you're not. You're not going to get 25% of the market. So there's this question. Peter Thiel says, start in a niche, but the niche should be part of something that's really big, okay? So, they're looking for market size. The next thing that we're looking for is what's called sustainable, a sustainable USP, okay? And a non-sustainable USP is a product who probably the feature is going to show up in the next Apple operating system, right? And you're going to be wiped out because everybody is doing what you're doing for free now. That's not a sustainable, business model. I used to represent a Dutch company before the internet really hit, which was called Route 66, and they were doing mapping software, Guess what? They're not around anymore, who's paying for maps, right? I mean, some people are paying for maps, and I think they made a decent exit and got out of it on time. And then the last thing I've talked about is it's really team, right? So make sure your team is together. The other thing, more angel again than VC, angels are kind of looking at the percentage versus the ticket size, okay? So just to let's say, my fund, we do 25K to 250K tickets. And by the way, that's like not a secret. Like if an angel investor won't tell you what their ticket size is, you really want to understand why. I mean, it's really not a secret. People should tell you their ticket size. But I'm also looking at how much of the company am I going to get? What percentage? Because the challenge is that I know you're going to be doing this for a while, and there's going to be a number of rounds, and if I end up getting diluted, the dilution is bad enough, but dilution really, really gets bad when liquidation preferences come in, right? That's how you really get screwed as an angel investor. The new investors come in, they're so powerful because you don't have your act together that they can put a 2 or 3x liquidation, and by the time you exit the company, the angels really don't get any money out of it. So that's an important thing that they look at. And the other thing is, what's the total, and these are the kind of things that you should have imagined. I'm not saying, Rolf Dienst says that it always takes twice as long and costs twice as much as you think, and he's never in 30 or 40 years ever seen a business plan that came true, okay? So it's not about whether the business plan is true, it's about whether you've thought about the business plan. Yeah, and also what that means is, how many investment rounds do you need to get where you're going? Now, a lot of people say exits don't matter, and we don't talk about exits and we don't care about exits. I mean, you don't want to walk in and say, oh, we're going to exit this thing tomorrow at this rate. But guess what? It goes all the way back to the beginning. Like, if you've got 3 founders in the company, how long are you guys staying around? How long are you going to be doing this? Is this like a 3-year adventure and then you're going to exit? Is this like a 9-year adventure? How long is it going to go on for? Is this like something that's going to become a mom and pop and you're going to be doing this 20 years from now? Because if you're doing it 20 years from now, I don't want to be invested. Yeah. So it's not that you have to be ready at the moment to say, this is my exit, it's going to happen exactly this way. But you as a founder owe it to yourself to understand how many investment rounds do you need to get where you go, get where you're going. Because, I mean, look, let's just do the math. Round 1, you give away 20%, you've got 80. Round 2, you give away 20%, you're diluting your 80 down to minus 16 is 64, right? 64% of the company after the second round. And now you dilute again by 20, and 20% of 64 is roughly 12 or closer to 14. And guess what? Somewhere around the 3rd round, you just crossed the magic 50% mark, right? And you don't have control of the company anymore. Yeah, and by the way, it's not usually good it's not usually good for the angel investors when the founders lose control of the company. It's really not such a great thing. So you need to understand how many rounds you're going to be going through. Okay, closing the deal. Here we go. What to consider? All right. Again, more for angel than for VC, because for VC, a lot of these questions are really obvious. If somebody has raised a 200, 300, billion, whatever euro fund, obviously they're a serious investor, okay? But I do want to say that you should know, are they a serious investor? And because there's a lot of people out there, especially in the angel world, who just love talking to startups. It's like a party thing, It's like, cool, let's talk some startups. It's so much fun, right? They're just wasting your time. Yeah, and the other way to understand is how many deals have they done and who are the deals, and can I talk to the other founders about the deal? Right, we just did a portfolio day in May. We invited all 20 companies and they all met each other and they're all connected. I don't have any secrets about, my founders should talk to each other, they should help each other. Do they keep their word? Are they responsible? Are you like constantly running after these people to answer you and they never answer? Because that sucks too, right? You also are trying to run your company. And, a real gut question, do you trust them? Do you trust these people? Because if you don't trust these people, you definitely don't want to get into bed with them, because it's going to be a really long road, right? And my formula on angel investing is 3 years. You're out in 3 years, it's a miracle, yeah? You're out in 5 years, you've done well. You're out in 7 years, you should be happy you got your money back, right? So somewhere around there is kind of the reality of the angel investing. And now, again, you should know what's their ticket size and when can they close. And how do you find out what their ticket size and when they can close? You say, what's your ticket size and when can you close? Right? Like, there's nothing wrong with asking an investor, what's your process? If an investor doesn't have a process, chances are they're not really that serious, right? You need to have a process as an investor. Why? Because if you're serious, you're looking at a shitload of deals, yeah, and you can't look at a shitload of deals unless you have a process. So ask people, what's their process? They should be able to tell you that. It's a very valid question. And by the way, do they stick to their process? So if you deliver something, do they come back to you when they said that they're going to deliver? And if they don't, do they let you know why? Other thing, really important, are they in the lead? Are they leaders? Okay, are they going to lead the investment round? Now, I can tell you, I am not a lead investor. Like, I will not lead the round, except in those rare cases where I'm the only one in, and then I don't have any choice but to lead the round, okay? So, but I don't lead. That's not my model. My model is I look at the startups, I get a sense of whether I really believe in them, I get a sense of the team, I see how far along they are, I think about who should invest, and we make a decision, we talk to our buy-rot, and that's the end of it, yeah? So, that's kind of like the process, but I'm not the guy who's going to lead the round, and it's important to know if you have someone who's leading, because the other people are going to be looking for that person. It's real work to lead an investment round. The other thing is that think about how many investors you're really willing to deal with, okay? Because what a lot of companies really screw up is they really screw up their cap table before they ever get to the venture round. Before they get to round, the A round, they've got like 20 people on the cap table, which is really cool and fun to have like 20 people because, because you can talk to 20 people. And by the way, I mean, you're a startup, so you got all the time in the world to talk to all 20 investors when they want to ask you questions. It's no problem at all. They won't call. When things go bad, they won't all call 20 at once. Damn right they will, right? So you really want to be clear. It's like, if you could do the deal with one, do it with one. If you can do it with two, do it with two. But if you have to raise it in a lot, try to bundle them. Try to pool them into a single GBR or something like that you put one entity on the cap table and not a bunch of things on the cap table, because a messy cap table is really, it just makes your A rounds and your further rounds very difficult to do. So the more investors you have, the more work you have, and think about how many you're really able and willing to deal with. Look, this next comment, a lot of people will say the exact opposite, so take it for what it's worth. In my world, I think talk money and talk valuation fast. I mean, why should you waste all your time going through all the steps and go through all the things and nobody's talked about the valuation, and you find out at the end that the angel thinks you're worth 1.5 million pre-money and you think you're worth 10 million pre-money. I mean, you could have saved yourself a lot of time there, and in the end, everybody's going to know what the valuation is. So why wait so long to talk about it? You just end up wasting each other's time. The other thing is, try to get a term sheet really fast. I mean, if you can't agree on a 2-page term sheet, you don't have to go into all the contract negotiation. You just don't need it, because if you can't get through the deals, the items on the term sheet, then you save yourself a lot of time and money and a lot of lawyers' fees. So the term sheet quickly is important. And the other thing is, you just keep in mind, it's like you are the one that's driving the deal. It's your deal. They've got a lot of other deals going on, right? So you need to be a step ahead of them. It's like when they say, okay, we're going into due diligence, your answer should be, do you want access to the data room today or next week? But the data room is ready. Like, that's impressive, All these things along the way, they're kind of like set up in a way to test you, to see if you're really ready for it, or whether they're, and if you're not ready and you're not driving the deal, and they have to like drag you through it, at some point the investors start to feel like, I'm not really sure this company does know what they're doing. And so a couple last tips and tricks, and then I'm really done. First of all, I would say one of the really important things is know your deal breakers. You should know when you're going to walk away. Yeah, and what that means is, again, that means that, coming back to the very beginning, that means that the founder team is really, really solid. Yeah, if you want to fight and you disagree between the founders team, then take it off, take it outside, go home and figure it out and make sure you're really together. And by the way, if you can't get it together as the founder team about what your deal breakers are, don't go start raising money, because it's going to be a really embarrassing and upsetting experience for you, because you're at some point going to go in different directions. Okay, so it's kind of like, I have 2 kids, 21 and 19, and one of the tricks about kids is mom and dad never disagree, right? Mom and dad are always together, right? It's not like if mom says no and you ask dad, dad says yes. No. It's not the way you want. The founders need to be the same way. It can't be that you don't let people play divide and conquer on you. The other one takes twice as long and twice as much money, so think about that. Another one is, always tell the truth, but don't always be telling it, okay? So I had the good and bad fortune to have 2 fathers. My dad, unfortunately, when I was in '88, was killed in a car accident. And he taught me about the truth. What he told me was, I'm too dumb to lie. Yeah, and so I just don't lie. It makes your life so much easier not to lie. Yeah, you don't have to remember them. It's really clean. It's really easy. You don't have to write anything down. You just don't lie, right? My second father is a psychiatrist, and he taught me, always tell the truth, but don't always be telling it. So what he meant by that was, it's like, in the negotiations, you don't necessarily need to jump up and volunteer the fact that, there is your key developer who does think that he's moving to Zimbabwe, It's like, when you find out that your key developer is moving to Zimbabwe, you better really go find your next developer, so that when you walk into the investor, you can say, well, we're doing a transition in the team, and here's the way it's going to work, and here's the people. So that's part of being ahead. But don't shoot yourself in the foot during the negotiations either. It is a negotiation, right? And the last thing is, almost last, second to last, listen when people are talking, like really listen, okay, and believe in yourself. Like people, they're looking to see whether or not you believe your own story, right? Are you really behind this? Are you really going to make this happen, yeah? And the last 2 points is, one, just remember this. You don't need to do this deal either. You should try your damnedest not to put yourself in a position where you have to do the deal. That's when it's kind of too late, and that's why all the things I've been talking about being prepared and thinking ahead and talking to people and listening is really important, because you don't want to be in a position where you have to do the deal. As soon as you have to do the deal, your valuation is going to go down and you're going to pay for it. And the last thing is something my grandfather taught me. My grandfather had a little bit more luck than his son. He went out to play golf, played 18 holes of golf, and came home and had a nice bottle of wine with his baby sister, and didn't wake up the next morning, and he was 98. So he's my role model. I'm looking for that contract as soon as I can get it. But what he told me was, he said, Andy, don't be in a rush to make a mistake. Yeah, and so I leave you with that thought. It's your company. Yeah, it's your equity. There's only 100%. Be really careful who you take in. Make sure that they're people that you trust, that you want to be with for a really long time, and who believe in you and are going to be there when the shit hits the fan, because it's also going to be a lot of fun to be with those people when you pop the champagne corks. And now I guess it's time for some champagne or beer. So thank you very much. Or questions. Questions? Sorry. Yeah.
How do you think the influence of foreign capital has made your job harder as an angel investor?
How do I think that the influence of foreign capital has made my job more difficult as an angel investor? Very frankly, I haven't noticed it in the angel investing area. I haven't noticed that that's a problem. I do think that especially in Berlin, in the VC level, in the round A's, you have a lot of Americans coming into the market, and so you see the valuations rising somewhat. But for the most part, it hasn't been too. It's still more deals running after the same money, so you're not in so much trouble at this point. Who else has a question? Yeah.
Thinking about crowdfunding or like ICOs as a method to raise funds.
So I think that. What do I think about crowdfunding, or can you translate ICOs?
Initial coin offerings.
Initial.
Like
coin
digital ventures.
Okay, got it.
Crypto equity.
Right. Okay. I haven't done any of those yet, so I don't know. But I have seen a lot of companies at the Entrepreneurship Center do the crowdfunding thing. Okay, so the crowdfunding, again, most of the crowdfunding companies that have made it now are pretty serious, and they do exactly what I was talking about. They bundle the crowd into a single entity, and then you have that. But if your crowdfunder is not doing that, you'd be careful about putting a bunch of people on the cap table. I haven't seen that people take crowdfunding quite as serious as they take crowdsourcing. Yeah, so I think that, for example, going out to the market with a product that's ready or not quite ready and selling the MVP, I think is a great strategy, right? Because you're actually not giving away the equity in the company. You're selling your product in advance. You show your investors that there's really a lot of interest in your product. You've got customers already signed up, and it's great marketing, and it's very, very low price marketing. But we've seen maybe 3 or 4 companies do the crowdfunding thing. And it has its pros and cons. I'm not really skilled in that area, but I would say this: before you don't raise money or you can't get your deal done, then go do crowdfunding. Yeah. Any other questions?
Yeah. What do you think about all these corporate VCs that are popping up?
Yeah.
Should the corporates do their job and offer exit channels and let the VCs do the financing?
Okay, so what do I think about the corporate VCs that are popping up? And shouldn't the corporates do their job, which is buy my company for a very overpriced value, and make all the VCs rich? And so yes, they should. The corporates should do that, but they don't always do it. Okay. So that's like, do we have another hour or two to answer this question? No, seriously. I think that, let's put it this way. There is a massive, massive amount of money in the corporate suitcases right now, and the corporate coffers are really, really full. And my view, to make it really simple and really, really fast, what I'm telling corporates is this. Number one, shareholder value has always been based on people wanting to buy your product. So your job as a corporate is to increase your shareholder value. Right now, the consumer is more empowered than they've ever been, right? So you need to go out and answer, what assets do you as a corporate have to answer this huge mobile empowered consumer? And now you need to start looking at how to do it. And the way you do it is you should invest in startups, yes, but you should learn how to build companies yourself at the same time. But you have to do this all at once. And so I think that that's what you see more corporates doing now. They're actually learning how to build companies in their accelerator programs. Like, I don't think accelerators are just a bunch of hype. It's like the precursor to having business building divisions inside of companies. And I think that the corporate investors are just realizing right now that they don't really know how to deal with startups. That's part of the problem. So it's like the problem with bringing in a strategic investor is usually when the corporate and the startup shake hands and they say, let's start now, the startup looks at their watch and the corporate looks at the calendar on the wall, and then you've got a kind of a problem. But on the other hand, there's a lot of assets in the corporation, right? It's like corporates today, if you manage it well, they've got massive end user bases that you can tap into. And if they just buy you and just do an exit, the chances are the team that got acquired is going to get swallowed, right? So, I think corporates need to find that balance between, I have literally a whole speech called How to Hug a Startup Without Crushing It, yeah? And I think the corporates need to build startup landing pads where they really bring the startup in, really show them the way, and open up their assets. That's what corporate venture capital should be doing. It should be opening the assets to the startup, giving startups access to that, and benefiting from the increase in the value. But just buying them and taking them over, I think, it's not a great track record, right, of success. So it's kind of a long, messy answer to a very short, succinct question. I apologize for that. Any other questions besides when can I have a beer? Okay, you can have a beer. Thank you very much. I'm here all night.
Sorry for that complicated question.